Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Geopolitical headlines have been driving a ton of market conversation, but how much of that actually filters into international equity returns? As the US and China continue to exert influence globally, where might those dynamics begin to show up in investable markets, even if at all? Joining us here today for a look at how global power shifts, political cycles, and valuation differences could matter for international equities. And here joining us is portfolio manager Patrice Quirion. Patrice manages several Fidelity funds, including Fidelity Global Fund. Happy New Year. Warm welcome to you.
Happy New Year. Pleasure to be here.
Great to see you again. Let's begin with, we'll invite everyone to send questions in, but also, what hasn't changed from last year? Because actually, over the course of the last 10 days, it feels like it's been a barrage of changes.
Yeah.
Investing-wise, what's not changed?
The reality is we spend a lot of time at the beginning of every year sort of thinking of what will be the new story in 2026 or whatever year we're in. The reality is the market doesn't care that this is the beginning of a new year. So as you should expect, the reality is our theses don't change overnight because we are in January. So as a result, most of my investment views are unchanged versus where we were last year. My views remain that international markets are starting to gather more attention. Flows are going back. Interest is going back. The valuation differential remains. It is a little bit less than it was at this time last year.
Because it was such low levels at that point.
Yes, last year we were probably like peak negativity right after the US election on international markets. That has changed in a big way over a course of the past 13, 14 months. But I think it remains. There is like a valuation differential, positioning differential that can create opportunities in international markets. What has not changed in my case, through the course of last year, I think Europe got a decent lift. So we were more selective from a big overweight position. We've taken profit in many areas, and we've allocated that to a good extent to Asia, and particularly China. That has not changed. I still think there is a very good risk-reward potential towards the Chinese equity market, notably around the consumer sectors, the technology, where there's some important breakthroughs coming out of there. Maybe one thing that is starting to change a little bit in my view of the world is after quite a few years of being significantly underweight in the US, notably around the tech sector, we are starting to find opportunities around the consumers. The consumer sectors are the sectors that are going to benefit from lower interest rates, which I think could be something different about 2026. We'll see the lag effect of the rate cuts that did take place and could continue to take place, maybe starting to lift the real economy. And this is a thematic that will apply globally, including in the US. So I am spending more of my time looking at generally more consumer, real economy, housing, transports related cyclicals everywhere across the globe. And I think that's an interesting opportunity for the year ahead that is different than last year. And
it sounds less regionally specific.
Yes, I think that's fair. Well, the past number of years, there's been enormous regional differentiation given the weight of the tech leadership, which is so heavy in the US, much less present in the rest of the world, given the slowdown that we've seen in China and the repercussions that has on Asia and Europe to some extent. I think this is likely to have less of a continued effect. And if anything, maybe a risk of reversal on that.
That's interesting.
But the pickup or the hope for pickup that we're starting to see signs of on the real economy, largely driven by lower rates globally, that has the potential to bring a reemergence of consumer confidence on like the traditional economy, traditional sectors. And I think this is pretty much the case across all the big geographic continents.
So when you take a look at things that are related to the real economy, you can talk about defensives, but the things that we use every day, we do every day, companies that produce things that are just part of our waking and living our daily lives, are sometimes smaller companies. Are you also going down cap?
Mm-hmm. That is one interesting thing that I'm increasingly tilting the portfolio towards. While the last few years have been really good for global equity markets, especially in the US, it's been a market that's been mostly driven by large cap stocks, partly from a factor of the sectors where those companies add the momentum. But also, I think a little bit of investors less willing to allocate towards those smaller companies, especially more cyclical ones, where they were impacted by that weaker consumer, by that slowdown in industrial demand and transports, etc. And it leaves us at a point today where increasingly small cap, to me, look interesting in terms of what expectations are baked in, how cheap are they on normalized earnings. And I think it's especially the case in Europe.
Oh, really?
It is across the board, but I think it is more visible, or the undervaluation seems more meaningful across European small caps. So this is a part of the portfolios where I did rotate out or reduce the big overweights in Europe, notably through financials that had been just really good performers for the past number of years. I reduced that, moved the money, as I mentioned, like a little bit more to Asia, a little bit more in the US, as we talked about, but trying to come back towards small caps in general, and maybe with a greater focus on European small caps that are tied to a recovery of the consumer, of construction, industrial, transports, etc.
The multinational story for companies, headquartered in Europe versus multinationals headquartered in the US, for instance, are they still cheaper than the US counterparts? Is that still there?
Yeah.
Or is that, I was doing a baby shark thing a while ago, has that closed?
It partially closed, but it certainly did not fully close, and far from it. So the international markets have done better than the US market for the past year or so. It's not because earnings growth has been superior. The US has still been leading the charge on earnings growth. But that very excessive valuation differential that we got to in late 2024 partially closed, and partially that is reflected on comparing multinationals very similar to US multinationals, either from Europe or from Japan, that were meaningfully less expensive. So for a global manager like myself, where we don't have constraint in terms of where do we allocate on a geographic basis, if I'm offered two very similar companies, one meaningfully less expensive than the other one because it is in a different market, just from a headquarter perspective. And that is starting to close, but I think there's still quite some ways to go on that. So I remain overweight on the international markets, in large part for that reason.
And the follow-up question to sort of the European versus US multinational question is actually the Chinese multinational question. Right. And how do you view larger companies there and smaller companies? But let's start with large.
So there's a very limited list of Chinese multinationals. China is more at a stage where the big companies are domestic champions, but with very limited out of China exposure, at least in revenues or earnings terms. That, in my opinion, will be a major change for I can't tell you it will be a major change for 2026, but it will be a major change for the decade to come.
They're building towards that quite significantly.
We are at that stage where the domestic champions out of China are slowly, and in some cases more quickly, trying to expand their power, bring their products to market, products that are increasingly very competitive, not only in terms of price, but in terms of quality of product as well, and trying to displace Western multinationals initially out of Southeast Asia,
maybe
the
South
CIS,
America.
South America has been one of that.
It's one of the calculations in some of the maneuvers we've seen geopolitically. It's just to make sure they knock out certain markets so that Chinese multinationals don't have as good a grip on those economies.
Yes, and I think we can use that as a transition to what's happening in Venezuela. But before getting into the specifics of Venezuela, I think it's important to understand that this Chinese-U.S. rivalry is certainly there. I think we are at a stage where the circle of influence of China has grown significantly, especially in emerging markets. It's been the case for a longer time in Southeast Asia, clearly CIS, Middle East, Africa. But
CIS?
The old Russia and the sphere of Russia. But the Latin America is in a way a little bit closer to home for North America.
And more controllable in that sense from a calculation.
Yes. Yeah. And this is where if we rewind the clock a decade or two ago, all of South America was essentially under the sphere of influence of the United States. And over the past 10 years or so, it has totally flipped, where most of those countries now have
ports. I mean, all things built and owned by China.
Yes, and the reality is China has been their big customer, mostly for commodities, but also like financing, infrastructure as one example. So China today has more influence on South America than the US has. And I think the Venezuela events here, a lot of the media puts the focus on this is for the oil reserves, which is probably part of the reality. But I think the bigger construct here is I suspect there's an element of the US trying to reverse that grip that China took on the continent. We are seeing it not only in Venezuela, we saw it with like pretty direct support of the Milei government in Argentina.
Totally.
And what does that mean for markets? The reality is Venezuela has no investable companies. Argentina had very limited, very small market cap companies. So that was not investable per se. I think where my mind is shifting is what is investable within Latin America. The only real country of size is Brazil. And we are going into an election year next year. And here it's all totally speculation, but I think it's not out of the possibility that the US tries to bring closer relationship, greater control on Brazil, and could do that by trying to support a more pro-business, more pro-US government as we go into next elections.
And many other countries have already in South America voted that way.
Exactly. Yeah. And certainly the US had like pretty big influence on the outcome in Argentina. Yeah. So if we were to see something similar, then suddenly Brazil, which is seen as a country always flip-flopping between pro-business or pro-population governments, maybe the odds are shifting higher for a more pro-business, pro-US government, which could create a more favorable setup for a country like Brazil. So I know this is sort of like further out in the future, sort of second or third derivative impact of what's happening in Venezuela. But in my mind, as a global equity manager, this is the kind of questions that will have an impact as opposed to something that is purely geopolitical, but not really investable for the portfolios, like what happened in Argentina and Venezuela.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
You mentioned commodities there, and that's a lot, certainly has a lot to do with what's gone on with Venezuela recently. With commodities, you invest, you put some of those into the portfolio, some of them are the producers themselves. Tell us a bit where tipping points are for various different, we know the precious metals side of things has been extraordinary. Is there a point where you take some of the chips off the table there?
Yeah, so to walk through my framework, I typically don't love investing in commodities. They are lower quality, more volatile, not really what I'm typically looking for in a portfolio. But if we get to extremes or very dislocated valuation, I will make occasional exceptions. And we did some of those, not on the energy side, but on the metal side, and especially around copper, going back a couple years ago when copper prices were $3 to $4 a pound, which was clearly insufficient to stimulate new mining development spending. Exactly.
CapEx, basically, yeah.
And the reality is, with a world that is electrifying everything, despite the maybe lesser focus on ESG today, the reality is electrification of everything is still going ahead, plus the demand from data centers, which is sort of adding to that trend. The reality is we need to continue to build electrical infrastructure at a very good clip. All of that requires copper. And at a price where that was insufficient to stimulate new mining, you could see an eventual, not an immediate, not a current deficit in copper production, but an eventual deficit that will need to be answered with higher prices. That, I think we saw this happening. The market realized that in a way over the course of the past 6 to 12 months. And we've seen metal prices, including copper, moving up materially to a point where now with copper around $6 a pound as opposed to $3 and something, there is the incentive to build new mines. It is economic to build new mines at this price. So I think it is less obvious to own the producer stocks because they already got the commodity price adjustment. I'm not saying it cannot go higher. It certainly can, but it doesn't have to, if it makes sense.
They can just produce at this level and put money into their companies at this level.
So in the portfolio, I have been reducing, exiting the producer side. But what that leaves us with is a commodity price that is now supportive of new development. So I think we will enter a phase of CapEx spending around commodities, especially around metals. Certainly copper, certainly gold at these prices where every discovery is profitable. And we do, or we have kept the exposure to mostly industrial companies that are selling into the commodity CapEx cycle. So equipment to mine, to build new mines. And we do keep those positions into the portfolio while we are exiting the metal producers that we've had.
There's a great question coming in right now, just coming back to the basics of international investing in many cases, and that is the US dollar, the weakness, the perceived continued either weakness, either further weakening, or just even sitting at these levels for some time. That is expected. What does it mean for an investor who wants to make sure they have exposure internationally?
Right. So there's been a lot of talk about the US dollar potentially being weaker as we see potential for repatriation of capital outside the US, potential for the US interest rates to converge lower towards where the ECB or the Bank of Canada already is, as an example. Like interest rate differential is a big driver of currencies. The reality is the US dollar has been pretty resilient, pretty stable through that. And I think the argument is maybe not so much on a guaranteed reduction in the value of the US dollar, although the interest rate differential could close further. So could be in theory supportive for other currencies relative to the US dollar. But I think there's maybe increasingly a need to think about the rest of the world or other currencies offering an insurance policy against maybe a less likely scenario, but a more dramatic scenario of concerns bubbling up around the viability of the US fiscal position, which could lead to weakness on the US dollar, especially if that was to lead to, and this is all speculation, those are opinions, those are not base case, this is more the insurance policy again, but if the solution to the current deficits in the US is to have interference at the central bank depress interest rates as inflation moves back up into an economic recovery scenario,
that's a concern for the
that
US
would
dollar.
be a very negative outcome for the confidence in the US dollar. And we're not talking about a scenario where it goes down a few percentage points and therefore you want to be in the rest of the world to capture that 2-3%. This is more like insurance against a scenario where the US dollars comes down materially. I can't tell you how much, but like well over 10%. This unlikely event, we would be extremely pleased to have exposure to not only gold, like what is happening right now, but to other currencies, especially currencies that are maybe on an economic basis undervalued. And the obvious one is the renminbi, right? Where every Chinese company competing across the globe is extremely competitive, probably as a reflection of the renminbi being too weak. So
and kind of on their way up fundamentally in a lot of ways.
Exactly. In the past, one would have argued that China needed a weak renminbi because their companies were solely competing on cheap products. But the reality is today they are not only competing on cheap products.
There's a demand.
Products are very cheap.
Yeah.
The Chinese corporate sector could still be extremely competitive even with a much stronger renminbi. So yeah, gold could be an insurance against that tail scenario on the US dollar, but so can other currencies, notably the renminbi, in my opinion.
Okay, let's actually stick with the U.S., but on a slightly different note. Lots of things are happening. We've got the stimulus that's sort of being dumped into the economy via the One Big Beautiful Bill, and that's ongoing and happening. What about the March to midterms? So that also is happening.
Like if we take a bit of a step back, the markets have been strong for the past number of years, but the economy has not.
Right.
It's been that K-shaped economy. The top like few percent of the population had a huge wealth effect, mostly driven by the AI and AI derivatives like lately. But at the same time, you had like the Main Street economy or the majority of consumers like feeling the brunt of cumulative inflation. So yes, inflation is a lower percentage, but we still had that massive run up that left the lost cars. We had the impact of higher interest rates. I know this is reversing right now, but the reality is today we stand at a point where the markets have done well, but the majority of the population, majority of voters are not feeling great.
Right.
And that needs to change going into the midterms if the current administration wants to have odds of keeping power. And
that usually means spending.
Exactly. I think it means combination of a few things.
And policy. Yeah.
Lower interest rates. I think that is why we are seeing so much interference or talks of suggestions of much lower interest rates at the Fed. I think we are likely to get those. We can debate magnitude, but rates are likely going lower because they are needed. The Main Street economy, everything tied to interest rates is seeing like very weak demand at the moment. The employment
the picture
situation is getting gradually worse. So we could get things like that. We could get stimulus measures. Don't know what form it may take, but could we get a tariff dividend check in the mail or something along those lines? Could we get policies around housing, a little bit like what's starting to trickle, like yesterday's announcement, trying to limit ownership of residential real estate by institutional investors? I think we will see more of these measures, but ultimately the goal, no matter what's the measure, is to get the Main Street economy improving from pre-depressed levels.
So invest in that.
And if we can find companies that are tied to the 80% of the population, like mostly consumer stocks, mostly tied to housing, because housing in any geography has a huge impact on the consumer confidence on the real economy. So if we can find housing plays, if we can find transportation plays, if we can find restaurants or retail that would benefit from that sort of cyclical bottom and eventual rebound of the real economy, the market is starting to hint at that. Some of those stocks have clearly made their bottoms. Clearly, it's not a guarantee, but
Yeah.
appear to have made their bottoms. A lot of them are still inexpensive on a normalized economic environment type of profitability potential. And this is why I was mentioning earlier, I think there is starting to be a subset of opportunities opening up in the US, which is very far away from the composition of the index, given the tremendous weight of the tech sector. But if you look at the S&P 500 equal weighted, that will be more representative of the real economy.
Yeah.
I think that after a few years of like tough performance there, we can start to see some green shoots starting to form over this year.
And as you say, it's sort of a global story, which is part of the thing that you started out saying. As we close out this discussion, I think just remind investors perhaps where your style of investing and ways that you're investing benefit. Who's it for? So you've got a Canadian investor who's probably traditionally been overweight US and maybe particular stocks in the US.
Right.
At this moment, walking into this new year, where do you think your fund fits? For whom does it fit in particular ways?
Yeah. So the quick pitch is essentially, I think we are or have just passed this inflection point of leadership between the US and the rest of the world. The rest of the world is much closer to the bottom of their economic cycles. The valuations are less demanding, while the US is closer to the peak of its cycle, mostly because of the tech sector and the impact it had. The valuations are much more demanding. And there's the currency tail risk, as we talked about. Well, we need to be careful about what we buy in international markets, because if you simply go and look at the broad European or Asian indices, you'll end up with a lot of large multinationals like consumer companies, pharmaceutical companies, banks that are maybe not giving you the type of exposure you want. I think what we are searching for, what I am building a portfolio to, is to get exposure on the parts of the market in the rest of the world and in the US that are depressed, where expectations are low, where fundamentals have been bad for a long period of time, and where we see potential of that improving. And this is very much tied around the consumer, certainly in China, increasingly in Europe, increasingly in the US. It's tied to housing in a lot of ways, or the construction derivative plays on that. It is tied to all of what's driven by that, some on the industrial side, some on the transport side, as I mentioned, and bringing an element of discipline around price. So the funds look extremely different from the indices, and I think trying to pinpoint the exposures of what we really want to have. So I'm not going to buy large banks in China. I'm targeting consumer or travel stocks or tech stocks that will benefit from the trends. I'm not buying pharmaceutical companies in Europe like most of the index. I'm targeting retailers that will benefit from an eventual recovery of consumer confidence.
This is really different, actually, to a lot of investing out there. It just has to be said. Okay, Patrice Quirion, we're going to thank you very much for sharing your outlook for this year, where you're investing, and just how different it is. I think investors really appreciate that. Thanks for your time.
Pleasure to be here. Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.